Today is my first radio show. Yes. I'm so excited. I'm excited to be here. I have some awesome information for you regarding real estate investing, real estate financing, how to keep your home abatement, grants, all kinds of great information for you guys. And I'm excited to be able to share it with you throughout this journey and with this real estate show. I will be here every Saturday from 10 to 11 a.m. So please make sure you guys mark your calendars to log in or, tune in basically to listen to this show. I promise you will get great information and it'll be very helpful. That's exactly why I'm doing this show. So just a little bit about Desiree real quick, because I know y'all like, who is this lady? Why is she on my radio? I don't know anything about her. Well, I am Desiree, again, Real Estate Diva McDuffie. That's my tag name. A friend of mine gave me that name many years ago, and it stuck. So I've been a real estate agent for the last 15 years. Started off with a small brokerage and moved my way up. I'm now with Caldwell Banker Realty in Center City, Philadelphia. Old City, Philadelphia. And I've been with that company now for the last 10 years. And I specialize in residential real estate. My passion, although I do love working with, home sellers. I love working with home sellers, but it's something about first-time home buyers that really does get me excited. So, I'm really passionate about getting first-time home buyers into their home, giving them their keys and, just being a part of that process. So, like I said, you guys will get a lot of information about that. I want to talk about the sponsor for today's show is Progressive Settlement Services, and they are located at 4729 Old York Road, Suite C in Jenkintown, PA. Their number is 215-332-9090. They are the number one, in my opinion, title company in the city. Very informative, very efficient in what they do. So if anyone needs any title services, please reach out to them. And next is I'm going to introduce my guest. I have been friends with this gentleman since 2008 when he walked into my office with his office manager at the time. And he walked in to get mortgage services, and we've been pretty much working since then. So his name is Jim Gillespie, and I highly recommend this gentleman. He knows his stuff when it comes to real estate financing. And we're going to go to break right now. And then when we come back, I'll let Jim give some more information about himself. All right, guys, I am back. Desiree, Real Estate Diva, here again. I am going to introduce my guest on my very first radio show. Yay! His name is Jim Gillespie. Again, he's with Paramount Residential Mortgage Services. No, what? Tell me the name. Come on. What is it again?
Paramount Residential Mortgage Group.
Mortgage Group. Okay, yes. Sorry about that, guys. Paramount Residential Mortgage Group. And he is I would say one of the best loan officers that I know in the business. I've been working with him for the last 15 years. So he has some great information to share with you guys. I'm going to ask him a few questions. So bear with us, okay? First, Jim, I want you to let us know a little bit about your business and how long you've been in business and, what makes you special in your business.
Well, let me first say that I am excited to be the first guest on the soon-to-be viral Desiree Real Estate Diva McDuffie radio show.
How about this, though? That's not even the name of the show. I've been saying it's Real Talk with the Real Estate Diva. That's the name of the show. So I'm messing up my own show name, y'all. It's Real Talk with the Real Estate Diva. But yes, thank you, sir.
Regardless, we've been friends for a long time.
Yes.
I am excited to be here as the inaugural person. We both grew in this business together.
We did.
And we went through all the changes from 2008 on. And there's been 1,000 of them.
Yes.
And I got into this business by accident when the market crashed in 2008. I lost my job, and I feel like I ran into the burning building while everybody was running out when I got into mortgages and everybody was getting out of mortgages. The Dodd-Frank Act gets enacted the following spring, which put rules to lending, and everyone had to learn it fresh because prior to that, I'm going to say that there was no structure as to the rules of lending and preventing people getting bad loans, preventing people from predatory lending, just preventing the consumer from getting screwed. And since then, I mean, I basically learned all the right stuff from when it came into the business. And again, me and you were struggling young people.
Yes, our stories are the same because we got in when, like you said, when everyone was running out. I was getting into real estate. I got licensed in 2007, met Jim in 2008. So we sort of grew up together in this business. While everyone was running away, we ran into it and we were able to learn how to do this business together.
Those first few years, it was scratching and clawing for everything you got. And I mean, the whole United States was going through transition. A lot of foreclosure, a lot of bankruptcy. Like people having to start from scratch. And here in Philadelphia, I mean, they gave a lot of incentives just so that people would buy homes. I mean, the giving incentive of property tax 10-year abatement if you renovated your home. Which at the time, had they not done that, I mean, I don't know what this place would look like. But because they did that, it spurred people buying, it spurred people renovating, it made ugly neighborhoods beautiful.
It changed the face of Philadelphia in a sense.
No doubt. I mean, listen, now there's at the end of the day, 10 years later, 15 years later, I mean, there's going to be a little fallout from it because people didn't pay property taxes for 10 years. And all of a sudden you get
this whole assessment.
I mean, all of a sudden you got money added to your monthly bill because you got to pay property taxes now that you didn't have to pay for 10 years. And then they could vary around Philadelphia by neighborhoods and by numbers. But I mean, listen, again, Philadelphia is a fantastic place, and it looks a lot prettier than it did in 2008.
Yes, it definitely does. It definitely does. I mean, some people have, some positive things to say about some of the things that's happened in Philadelphia than others. So it's some positive and negative aspects. But we're not. This is not the show for that right now. We're going to talk about that on another show. I mean, I'm going to bring on some people to discuss the changes that have taken place in Philadelphia, positive and some negative, as people would say. But let's talk real quickly about what's going on in the market today with regards to interest rates. I know that's why you wanted to come on, to discuss some of the the solutions in the market right now. Interest rates have risen, about 3 points since the beginning of the year or something like that. It's just crazy. I was looking at something earlier today and they said a person that purchased a $900,000 house when the interest rates were 2 point something has the same monthly mortgage amount as a person who purchased maybe close to about a $400,000 house, today with interest rates close to almost 7%.
Well, let's rewind. Let's look at this from 2008. In 2008, interest rates were about 6.5%. And at the time, 6.5 was good.
A good interest rate. I remember, listen.
At the time, 6.5 was a good interest rate.
It was really quick. I remember when we were working together and someone said that they could get a 5 point something. I think it was like 5.25 interest rate. You were like, no way. Like, there's no way that's going to happen. And that was in 2009. But I'm just saying that's because the interest rates were in the sixes at that time. And it was just like they were not coming down. You know, there was no foreseeable, future that they were coming down at that time. So,
I mean, listen, like, I feel like I feel like you and I have a huge advantage in this in real estate, in lending, because we have experienced everything that's happened
absolutely
since that crash. And I mean, there's been hills and valleys, and so many different economic factors as to why rates have gone up and down.
Mm-hmm.
But like I said, back in 2008, it was around 6.5. Fluctuated over the next 3 years because the world didn't know what the hell was going on. The stock market almost had to rebuild.
Mm-hmm.
Everyone's 401k was gone in 2009.
Yeah.
It all rebuilt. But it came like, I mean, to me, it all comes back to when responsible lending got enacted, and people
Which was necessary.
It was completely necessary, and it was completely that we had to, as a nation, have checks and balances for giving out loans.
Absolutely.
And because of that, I mean, again, different industries grew, others faded out, but like the economy grew strong because people weren't overextended.
Mm-hmm.
People got out of that hole. They were in a huge hole 2008, 9, 10 from the crash, and everyone built their way out. Responsible spending after that, and with that comes inflation going down, rates going down. In 2014, I vividly remember the rates had got to 3.25. At the time, the world had never seen rates that low.
Yes.
And I refinanced myself and everyone that I knew at 3.25. And I'm like, guys, life will never be this low again.
Mm-hmm.
And then subsequently it went back up in mid fours, which is where life is normal. And it went back up, and then in 2016, the day after the election, rates went up 1.5 in one day. Worst day as a lender, the worst day that I've been a part of, because we had no idea that the economic impact of 2016 would cause that. And so many people are in the process of buying a house or refinancing, and if we were getting closer to their closing date and waiting for the right day to lock their loan, all of a sudden we had to have the conversation that the stock market just raised interest rates to that. All right, so we get past that. We're going. And rates are in the fours again. And then when the pandemic hits, I mean, no one knows what's going on.
Yes.
And for March of 2020, mortgages are traded, and mortgage as groups of loans to servicer investors. That's who you pay every month.
Okay.
And they're traded on the stock market with mortgage-backed securities. And when the pandemic hit and the lockdown came and no one could work, no one could go to their office, the stock market didn't know what to do. They didn't know if people wouldn't pay their mortgages. If they don't pay their mortgages, everything falls apart. They didn't know if a lot of rate is based on risk value. Well, all of a sudden rates jumped up because the risk of being an investor and getting your money back was unknown. everyone like was scared that people wouldn't be able to pay anything. And then we installed an option of forbearance where people had a certain amount of time where they didn't have to pay their mortgage, and it would get moved to the back of their mortgage, just so that just until things stabilized. And again, the like no one knew what was happening because it was the first time in the United States. I mean, first time worldwide, really, for what was
like
happening.
Yeah.
And to our like for 5-6 weeks, we couldn't close loans because no one wanted to buy them as an investor because no one had any information.
Yeah.
No one had any information as to what the future was going to hold. And then it was like the light went on and rates dropped in the 2s.
Wow.
And none of us knew what the hell to do at the same time because we had never been there before. Like it was like we had never experienced rates that low before. And it like, I mean, in essence, in financing, like it was almost free money to be lent.
Yes.
For people buying a house, people like in a home equity line of credit, like it was almost 1-for-1 of we'll give you this much money and you give us that amount of money back. And that went on from June 2020 until like November of last year, November 2021. Rates were in the 2s. And then like some people thought it was going to stay there forever. I mean,
oh yeah.
Like, I mean, and like there were a lot of people that came into the real estate business, came into the mortgage business and just experienced that.
Yes.
And they thought that
was going to be
life was great. It was always going to be great. Well, now I didn't want to be a pessimist, but I was like, guys,
this is not it forever.
You are in the golden era of real estate. You are in the golden era of mortgages. It's not always going to be this easy. This. It
may never be that easy again.
It's not always going to flow like this. I'm like, because I mean, one thing about it was, because of forbearance, because of people not having to pay their mortgages, because of people, like transitioning from working in an office to remote, working in certain like dense cities, moving to more open spaces due to COVID, due to a lot of factors, being able to work remote all the time instead of having to work in a big building in an office. They wanted to move to get more land, cheaper areas. All that was happening, and to help everybody out, from June 2020 until January 1st, 2022, no one was allowed to be evicted. No one was allowed to be foreclosed on. 18 months of going out of normal cycle, because if people are late, I mean, whether you're the landlord, whether you're like in the neighborhood and the house gets foreclosed on, everything changes when those little things happen. It was a stalemate for 18 months. And then January 1st hits, and then people are able to get evicted again. People are able to get foreclosed on again. People haven't paid their mortgages because of forbearance for X amount of months. And now it's all at once. Like all of a sudden everything's happening at once. And the general public doesn't really know all the stuff that in the real estate and the lending side that's getting thrown on everybody.
Yes.
And like the additional stimulus checks of $600 a week when people were laid off, not having to pay your mortgage for that X amount of time, it inflated people's bank accounts significantly. People bought a lot of stuff, left shelves dry.
Yes.
That's where inflation comes. It's a supply and demand thing when it comes to that. And it all hit
that led us to where we are today.
It started in January, February when like they were trying to normalize, take away that 18 months out of life and get back to where it was prior to that and stabilize everything. Well, we got to make up for that 18 months.
Yes.
And it's hard on it's hard on everybody to go from that to this. But that's where rates went. But like just to put in perspective, last November, people could still get 2.75 as a 30-year interest rate. Amazing. I mean, rates have continuously creeped up since February, to where we are somewhere between 6.5 and 7.5 right now.
Do you foresee them going up even more?
I have no idea.
And no one knows, right? No one knows.
No one knows. Like, I mean, like when is when?
Yes.
Like, if I knew they were going to be here, I would have put money on a certain part of the stock market and be a trillionaire right now.
Absolutely. Me too.
But like, just to put in perspective, 2.75 times 2 is 5.5.
Yep.
We are more than double the rate of interest
last year, this time, or close to
last
this
year.
time.
Like, so to that point of the $900,000 property being the same as a $450,000 property, yes.
Wow, that's crazy.
Yes. But that's just simple math doing multiplication.
But to put things into perspective, right? So if we go back, because I don't want people to get so discouraged that they feel like they don't want to buy, interest rates in the 80s and 90s, I know neither of us were in the business, but I know when my mother bought her house, her interest rate was like, I don't know, somewhere around 17 or 18%. And people were buying houses then.
A million percent. A million percent that like all that is accurate, but they were also buying when values were like $60,000.
That's true.
For what's now $300,000. I guess in the lending business, like you got to look at it like this. It doesn't matter if your rate is 3%, if your rate is 5.5%, if your rate is 8%. Every month, you're paying some of your principal off, and it's your asset.
Absolutely.
If you are renting, you are paying 100% interest, and
that's a good way to put it. Yes.
And you are paying 100% interest, and you are paying somebody else's asset off.
Absolutely.
Your landlord is smiling
because you're paying off their mortgage.
You're giving them.
So you're paying a mortgage regardless.
You're giving them retirement wealth.
Exactly. You're paying a mortgage regardless. You're just paying your landlord's mortgage.
And to that point, like no landlord is going to charge you less than what his mortgage payment is.
1,000%. You're right.
So whatever you think. Oh, I can get this place for this much. Well, somebody else has it for cheaper.
And you're paying it off. So like you said, you're paying off someone else's asset. So to that point, if you purchase a home, at some point that mortgage will be paid off. Rents today are at an all-time high, even today. So they're not going to come down. Rents have increased. My parents, when they first got married, I mean, again, many, many moons ago, right? But if we think about what a house in the same neighborhood, let's say Gray's Ferry, small house in Gray's Ferry, and maybe, I don't know, the 70s or 80s, I think they were paying like $40 or $60 a month. Like crazy numbers, right? Same house today in that same neighborhood will rent for maybe $1,800 a month. So if we're all getting older, right? We're all growing, we're getting older, and who wants to be paying rent at an inflated rate? That was in my lifetime. So from $60 to $1,800 for the same house. I wouldn't want to have to pay that money. Think about it. By the time I'm 60 years old, rent for that same house will probably be maybe $3,000 a month. And then at that point, I'll be on a fixed income. So it makes sense to buy a house, pay that house off, and it's yours. All you have to do is worry about paying your taxes, maintenance, obviously, and insurance.
You're discounting all the advantages of buying a house.
Mm-hmm.
Like,
there's a ton of advantages.
I mean, listen, me and you lived a few blocks away from each other, and I bought that house in 2011, and we fixed it up, and
I sold it, by the way, y'all. Go ahead. I'm sorry.
And all of a sudden, it was worth $150,000 more than what we bought it for.
Yes.
4 years later.
Yes.
And all of a sudden, you have all of a sudden you have asset equity that you can use for whatever in your life you need to benefit yourself, to pay off debt, to use to reinvest in other things.
Put these kids through college.
Whatever it is, all of a sudden, that's been like, I mean, having that appreciable asset. I mean, listen, like we've never seen values the way they are right now, and when foreclosures hit, foreclosures are sold for a little less than market value due to the bank or the servicer that owns them trying to recoup the money that is owed on a house. But to that point, it's not going to be like it was in 2008 because there's more money owed on the house. Values are not going to drop as significantly in other houses because of the comparable sale of a foreclosure. And the one thing that is in 2022 that was not in 2019, 2015, 2007 is that the lowest income people are making $17 an hour.
Yes, that's true.
It's not $7.25 minimum wage anymore.
Yes.
And all of a sudden, people can afford more. So values are going to stay relatively where they're at because more people have money.
There you go. Exactly.
And
that's a question that a lot of people ask, where the price is going to start, coming down dramatically like they did in 2008. And
it could never be like 2008. But listen, in 2008 up to 2020, like minimum wage was still $7.25.
Yeah.
Like the lowest income workers were making that, where the lowest income workers now are $10 more an hour. And just like everything increases with that.
Absolutely.
I guess all my points to everything is owning a house, having that as is the best investment you can make in your money.
Okay.
Like, because every month, you have to live. You have to live somewhere. And again, if you're paying off your own debt or you're paying off somebody else's debt, you gotta live. Might as well pay off your own debt.
You might as well pay off your own debt still live.
And still live. And listen, at some point, I don't know if it's going to be in 2 months. I don't know if it's going to be in 2 years. I don't know if it's going to be in 5 years. But like that 7.5% rate, whatever the rate is, at some point it'll be 5%. At some point it'll be 4%. May not get too much lower. We don't know. We don't know. But like at some point it'll be a little bit lower. And you get that lower rate. And then, like, your monthly payments go down. Your rent's never going down.
Never.
Your rent's never going down.
Going to go
and
down.
And every time that you pay that rent, if that landlord got a lower rate, they just made more money.
Exactly. And a lot of landlords did, refinance during that time. And so either way, you're paying a mortgage. You're just not paying your mortgage.
Right.
Absolutely. So really quickly, how would a person qualify for financing today? Like, what are the minimum requirements with regards to not interest rates, credit scores, and, down payment money? These are some of the questions that, I get quite frequently. So we have the expert here right now. So
let me make it as easy as possible.
Okay.
Like, again, rewind back to when rules were put in place back in 2009. Prior to that, people could there was insanity that people could do what's called a stated income loan, which is you just said what you made, and people wrote it down and went with it. Like, and you didn't have to be accurate. You didn't have to prove anything.
Wow.
And
that's how a lot of people got in trouble.
That's how the market crashed
Yes.
because people bought for stuff that they shouldn't have been able to afford.
Mm-hmm.
Now everything is documented, and where we take a 2-year history of everything, a 2-year your living history, a 2-year your work history.
Take notes, guys. Go ahead.
What your income is, your gross income, not your net. Your gross income before taxes and insurance and retirement, whatever. And then we take what your credit and your debt and your credit and your debt on your credit report are, and we establish based on your debt and your income how much you can afford to stay within parameters so that you still have money to live after you pay your debt on a monthly basis. And just trying to use round numbers here. Let's just say that you made $60,000 a year. 60,000 divided by 12 is $5,000 a month. And let's say that you have a car payment of $500. Let's say you have a student loan of $300, and a credit card of $100, and a timeshare for $100. That's $1,000 worth of debt, $5,000 in income. 1,000 of 5,000 is 20%. On a normal basis, we can lend up to 50% of your monthly income. So to get to 50% of 5,000 is $2,500. We can lend up to $2,500 of your monthly debt, of your monthly income.
Okay.
And if you're already at 1,000, you have a $1,500 window here that you can do for your housing principal interest, your property taxes, homeowners insurance, and mortgage insurance, and if you're in a condo fee. And you're the expert on neighborhoods, and in Philadelphia, neighborhoods vary exponentially on property taxes from one neighborhood to the next. The less property taxes, the higher purchase price that you can fit into that $1,500. The higher property taxes, the less purchase price.
Absolutely. So that's why people's in the Philadelphia area, especially, a lot of people don't understand if they buy in Philadelphia versus buying out in the counties, their pre-approval amount may decrease because of the increased amount in taxes.
The property taxes in the 5 suburbs are significantly higher than what they are in Philadelphia. Significantly.
Still, even with the increase in
increase in 2014, correct. But all that said, we take a credit application so that we can understand your living history, income, debt, and if you have a spouse or you have like somebody else that's living with you, we take all of it and we put it all together. Generally, the minimum credit score that we can get approved is 580.
Okay. Well, most lenders will say around.
Listen.
Go ahead.
Like the cost of money is higher these days because of inflation. The better credit, the better cost of a rate, the better rate that you get.
So what does that look like? 580 credit score. As far as financing, what does that look like? Is there more money that they would have to pay? How does one qualify for financing with that interest rate?
Well, listen, there's, I mean, there's different programs out there that it's a case by case basis as to what people can like what programs people can get approved for.
Okay.
What if they fit into a certain criteria of like Philadelphia has a first time home buyer grant program.
Home grant.
It has certain criteria of total income, credit, assets that people have, to whether they can qualify for it or not. It's going to be a case by case basis. Anyone that calls me, I always evaluate their credit and say, listen, here's where you are. If we do this, this, and this, we can get your credit here. I don't care if your credit is 560 and we can get it to 620, or if your credit is 680 and I'll tell you, we do these little things and all of a sudden it's 725. The higher the credit score, which is the mid score of Experian, TransUnion, and Equifax. The higher the credit, the better your terms are to get financing in anything, whether it's a mortgage, whether it's credit cards, a line of credit, whatever.
So as a loan officer, you don't just tell people, no, you don't qualify. If they don't qualify right away, you do, assist them or give them information, that the information they'll need to be able to help them to increase their credit scores. Like you'll give them
before there were rules. Before there were rules, it was very tough to say, if we do this, this, and this, you can get to this. Now that there are rules and I know how to work within the parameters, I can look at anybody's like credit profile and understand the different things that can boost it.
Okay.
What hurts it? Like, I mean, and different techniques to increase someone's buying potential.
Okay. Well, thank you so much. Really quickly, so we're going to take a call. We're going to take our first call. We have Yolanda on the line, and she has a question about interest rates. I think this is my girl, Yolanda. I don't know. Let's see.
Hi, how are you? It is Yolanda.
Hey, Yo-Yo. How are you?
I am good.
Good.
I was listening, and I can't remember the name of your first guest on the show.
Jim Gillespie.
Jim. Hi, how are you? So you were offering some good information about interest rates.
Yes.
In the next 6 months, if somebody was planning on buying, would you recommend it, or do you think they're going to hold steady? Like, what is your recommendations on that? Because I do have a couple of friends interested in buying, but they are scared that they'll either be, the rates will shoot up even higher.
I mean, listen, like, none of us have the crystal ball. I mean, we all, like, I try to keep up with all the industry news as to the way inflation's moving, the way the programs that are going to be out there, the wages of people, to try to like gauge educated suggestions. I mean, as much as I do that, as much as anybody in the industry does it, none of us saw this coming.
Yes.
None of us knew this was going to happen the way it happened. Like we have a saying that in the mortgage business, when we're talking to people that are thinking about buying, inventory is low on houses. If you find a house you love, marry the house, date the rate.
Okay.
You can always refinance when rates come down.
Yeah.
Mm-hmm.
Yep.
You're not married to the rate for 30 years.
Absolutely.
But if you find the house that you want, you have no idea if a house comparable to that will come on the market in a couple months, ever.
Absolutely.
That right there, that analogy was perfect. So thank you very much. And congratulations, Des.
Thank you.
This has been a good show.
Thank you so much. I appreciate you, girl.
You're welcome. You guys have a good first day.
Thank you.
Thank you. Okay, I think we have another caller. Our next caller is Tammy. Tammy,
I'm here.
are you there? Hi, Tammy.
Hey.
Hey. This is my girl Tammy. All my little friends calling in. Yay. All right, yes, this is my girl Tammy. Tammy, did you have a question?
I had a question, 2 questions and a comment. Is that okay, or do we only have time
Oh,
for the
absolutely. Go ahead.
question? Okay. Hi. First of all, Jim, this is great. Like, this was really, really informative. And
Oh, wow. Thank you.
if I was not a recent first-time home buyer, I would definitely jump on, like, right now. Quick story, I have a best friend that's this real estate diva that gets all these awards and stuff, and she's been telling me for years, now is the time to buy, now is the time to buy, now is the time to buy.
Mm-hmm.
Finally, I took her advice, and I bought. And then, like, 2 weeks later, the rate jumped
up. Yes.
1.5%. And I
So
was
did you
like,
make a
I
good
would not-
decision right then and there, honey?
I made a good decision. I would have made a better one had I acted a year ago.
That's all right.
But I made a really good decision.
Mm-hmm.
And about that decision, I had a question.
Mm-hmm.
If someone is looking to refinance and the rates are going up, how do they get the equity out of their home? Like, what would be the best way to get that full equity? Would it be best to wait? Would it be best to do a HELOC? Like, what would be the best action?
So without knowing anything about the person, without knowing anything about the property, in lending, we can, on a cash out refinance, we can lend up to 80% of the appraised value.
Okay.
So it doesn't matter what the rate is. If the house appraises at 100,000 and you owe 65, we can lend up to 80,000 for your new mortgage. If you just bought a house, your value of your house is going to be the same value as what you purchased it at for the first 12 months. And then it doesn't matter what the appraisal says, you can't be lent more than the money that you purchased it for in the first 12 months that you own it.
That's good information to know.
Oh, that's great information.
Mm-hmm.
That is great information. Another question. Jim,
Yes.
What is your contact information in case anyone had any questions that they wanted to direct to you and didn't get a chance to call into the show?
Sure. I can give you, I'll give you, my name is Jim Gillespie. I have an online application, JimGillespie1.com. It's JimGillespie, the number 1.com, and then click apply now. On that website, it has all my contact info, my phone number, my email address. My email address, jgillespie@prmg.net. It's JGILLESPIE at P as in Paul, or P as in Paramount, R as in residential, M as in mortgage, G as in group.net.
Perfect.
Thank you so much. I'm sorry. Go ahead.
Well, no, and listen, anybody else that's out there, I mean, Des has all my contact info on speed dial.
Absolutely, for 15 years.
Yeah.
Yeah. So, but Jim is going to have an opportunity right before we finish for the day to give his information again. If anyone did not get it, we're definitely going to give him an opportunity to give that information again. Okay.
And please do more shows like this. This was awesome. And
Thank you,
you're an
honey.
asshole.
Thank you so much. Thank you so much for
Have a good one.
getting in, calling in. Thank you. All right, Mama. I'll call you later. All right. All right. So we have another caller, Maisha. She has a question about a credit score. Maisha there?
Yes, I'm here.
Hi, Maisha.
Aisha.
Hi, hello.
Hi.
Good morning.
Good morning. What's your question, honey?
Well, it's
this
it's more so-
Naisha.
Yes,
Not
Naisha.
my
Hello, good morning.
The engineer said, okay. Hi, Naisha. Hey, Nana.
Naisha, yes.
Okay.
Hey, good morning, Tess. Congratulations. I'm so proud of you right now.
Thank you.
And
Thank you so much.
I'm very intrigued by all of this information. You're welcome.
All right.
Okay. So basically, it's more so.
Uh-oh. Did we lose her? I can't hear her. We lost her? Okay. If you can call right back in, we actually lost you. So if you can come back in. So, all right, guys. So, Jim, you can continue on about all your wonderful information about real estate financing. So you were saying that if a person does want to refinance or, go to home equity loan, they have to wait at least a year to be able to do that.
Yeah, I mean, listen, like as a lender, we can't honor value going up for 12 months of your purchase.
Okay.
I mean, you're like it just comes with the territory. But if you've owned your home, honestly, since like you bought 2020 or before, you have equity.
Quick question for you. Someone actually asked this question of me the other day, and I'll allow you to answer as the expert. What's the difference between a home equity line of credit and a home equity loan, and which would you recommend for an individual?
So home equity line of credit,
HELOC.
Well, so a home equity line of credit and a home equity loan, are two separate products outside of your mortgage. Like those don't you continue to have the same mortgage that you have, and then those are separate loans. A home equity loan is, let's just say that let's just say, just hypothetically, that you owe $150,000 on your home. Your appraised value comes in at $300,000. So you have $150,000 in equity. We can lend up to 80%, which would be $240,000. So you have $90,000 of equity right there. A home equity, you could take a loan of $90,000 as a home equity loan, and that's at a fixed rate, and you get all $90,000 then. Or you could take a line of credit where you can take zero, but you have $90,000 available, and you pay as
you take it out.
And you pay as you take it out. You pay it, and you can pay it back. Still have that line of credit, but it's a variable rate, and it can go up, it can go down, based on the institution that you get it from.
Okay.
But the home equity loan is a fixed rate. You get the money. That's a closed end loan. A home equity line of credit is considered an open end loan because it can be for $40,000, then it can be for $20,000.
So each time you take, let's say,
and your monthly payment is based on what you owe.
Okay. So let's just say I take out $20,000 right now. I have a HELOC. I take out $20,000 right now. It's at interest rate of, give me an interest
probably
rate right
9%.
now. 9% right now, and then I start making payments on that $40,000 at 9%. I would say 5 months from now, I want to take out another $20,000. Right?
Yep.
Will the 40 remain at that 9%, and then the 20 is at a different interest rate?
Nope.
Okay, go ahead. Explain for me.
It'll adjust. It's a rolling number that'll adjust as the market changes.
As the market changes. So even on that $40,000.
I mean, your rate could go lower as time goes.
Okay, so each month is really adjustable.
So just understand when you hear about the Fed interest rate hikes, the Fed interest rate hikes are for they are not mortgage interest rate hikes. The Fed interest rate affects credit cards, lines of credit, car loans, that stuff.
Okay.
as Fed interest rates go higher, your home equity line of credit rate would go higher.
Okay. Listen, Jim, I want to thank you. This has been so awesome. Like, you gave some amazing information to our listeners. You definitely have to come back for me.
Anytime.
Yes, you have to come back. My old friend here. I want to give you an opportunity, because we only have a few minutes left, to go ahead and give your information again, and so that everyone can reach you, get you some business out of this.
I mean, listen, if there's one thing I think everyone should know, I think everyone should know their buying power. Like, it doesn't matter what your credit score is, doesn't matter what your income is. It's your whole credit profile, like all of it combined. And we do a credit app. I'll break down for you where your debt to income stands, what you're buying, where with your assets, what you can afford. And then you can take that and say, and we can say, oh, well, if you do this, it increases your buying power. Or you need this much more money to get to this, that you can buy this much. Okay. Everybody else, you're blind. You're flying blind until you know your buying power.
All right, so give them your information really quickly, okay, so that they can get in contact.
Again, my online application website is jimgillespie1.com. JIMGILLESPIE, the number 1.com. And it has all my contact. It has my cell phone. It has my email, but it also has the online application where you click apply now. And I hope to work with as many people as I can in the future. Absolutely. Thank you, guys. Thank you so much for tuning in to Real Talk with the Real Estate Diva. And I just want to say congratulations. Thank you. I've seen Des along this whole journey, and I'm very proud to be your friend. Thank you so much. I love you. Thank you. All right, guys. Talk to you guys next week. www.phillyrealestatediva.com is my information. Check me out. Bye.